And welcome everybody to the Horowitz Company Year-End Outlook. We're talking about trends. We're talking about themes and opportunities moving into 2022. Hey, this is Andrew Horowitz, and thank you so much for joining me today. There was a lot of discussion about whether we're going to do something towards the end of the year, and I think it was really appropriate given the fact that the year that just passed was in this incredible recovery, and we had these great opportunities, and the questions keep coming in about, hey, well, what's next? So I thought we would go through some of the important features that look back at 2021 and then move into 2022, give you some opportunity to ask any questions that you like as well. Before we go any further, first of all, I want to mention that we are recording this and it will be available. We'll send an email out to you. It'll be available on thedisciplinedinvestor.com. We'll have it posted as a video, audio opportunity for you to watch it. But also, it's important that we have these disclaimers that this is not a recommendation to buy or sell any security, and past performance is no indication of future results. Nothing we're talking about here constitutes legal, accounting, or tax advice or individually tailored investment advice. And it's important to also understand that Horowitz Company, Inc. is registered as an investment advisor with the state of Florida and conducts business in other states where it is properly registered or is excluded from registration requirements. And you can see the rest of that on the bottom there. So just something to take a look at. As I mentioned, we are going to have questions, Q&A session. Now, do me a favor. Please post those questions in the Q&A panel. So there's a chat panel and there's a Q&A panel. Make sure that we open those up in the Q&A panel so they get queued properly. Any question that you want to ask is okay. There is no good questions or bad questions. There are no smart questions or dumb questions. Anything that you want to ask is just fine. So go ahead and do it. Don't be nervous. Don't be concerned. Get them in the Q&A. So we are going to go through a variety of things. Let me take you through some of that right now in terms of looking at it as an outline form. So first, we're going to talk about the reflections of 2021 and then get into a look forward into some of our expectations for 2022. We're going to look at markets and sectors and trends within each of those and how they played over time, as well as what is going on with regard to some place we think will be beneficial opportunities moving forward. Also, just touching on investment strategy overview, some of the things in the TDI managed growth strategy, global allocations, investology, and Q&A. So we'll go through all that, and I think that's going to be an important way to communicate some things. And I think I guess I'm excited right now about some of the opportunities that I see and the areas that have some things that are really interesting. At the same time, there's a lot of areas of concern. I mean, it feels like we're on the precipice of both a incredible breaking out opportunity, something really great, and in a way, something terrible. It's like, where do I want to be? What do I want to do? Because there's both sides pulling apart from the center. We have this incredible stock market and cryptocurrencies and the bond market and even commodities keeps on giving and giving and giving. And at the same time, you wonder and you stop and you say, well, hold on a second. When does this end? So what I thought we would do is during this conversation today, we would open this up and we would start by having a couple polls that we would put up. And the first one that I want to put up, which is, by the way, a multiple choice, you can pick more than one. We'll let this run in the background as we talk, is the biggest concerns for 2022. There's a lot of different options I put on here. I probably didn't put all of them, but I put a lot. So the question is, what's your biggest concern of 2022? You can see hopefully that poll has popped up on your screen right now, and you can answer that. And then we'll get back to it. But you can also put multiple choice. Now, nobody's answering any of these. I hope this is working. Is this poll working? Anybody see that poll? It didn't work. Really? What's that about? Really? Hang on, I'm going to end that. I'm going to relaunch the poll. Here we go. Relaunching. Let's see if that works. There we go. Something was a little weird. Yeah, now it's going now it's going crazy. So yeah, there we go. A lot of people here on this call today, so that's great. So let that run in the background. We'll get to that in 1 second. I'll go over what the results are. And let's talk about some of the things that happened in 2021, the themes that really shaped the markets and the world of 2021. Clearly, number one on the list is COVID-19. Now, this is not in any exact order here, but clearly the whole pandemic was a big part of the year. From the pulling out of where we were, the whole idea that, wow, we were in this incredible lockdown where we just pulled the plug on the economy in 2020 and then had to restart this whole thing, right? Where we got into this question of whether we're going to get back to any kind of level of normality. It was a great year. We came out of the darkness. Most risk sectors did very well. Most important, we have our health with the vaccines right now, all that's going on to really battle this. Putting, of course, Omicron on the side, the variants and all that's going on right now, that's something new. But it was newsworthy. COVID-19, the pandemic, was all over the news, and the markets reacted very violently and in the end very favorably to all that was going on with regard to the pandemic. And it was interesting because a lot of people that I talked to throughout the year, at the end of 2020 and into 2021, and they were all talking about, hey, this economy and this situation, it's all propped up. It can't last. And I tried to explain that what we had was an incredible amount of money that flowed into the markets, flowed into the economy, not only here, but worldwide. And it didn't only come from here into our markets, it came from other markets, other places, other governments, other stimulus into our markets. And then from there, our money flowed into other markets around the world as well. And there was so much, trillions upon trillions. The Fed's balance sheet went from $4 trillion up to $9 trillion. We saw stimulus programs in the $3, $4, $5 trillion come forward, whether it was the PPP program throughout 2020 into 2021, whether it was other stimulus measures. There was 6 bills in total that were passed, and we still have one to go, the Build Back Better, the Triple B. That's kind of going right now. So what we're seeing right now is that there is a significant amount of liquidity that is going on, and that all came from the Federal Reserve. The Federal Reserve had an accommodative policy, and they really, even through today's FOMC meeting, they continue to be accommodative. They continue to be very much aligned with markets. We're going to close that poll in about 1 minute, so anybody that wants to answer that, by the way, in the background, do that now. But the Federal Reserve has been extraordinarily friendly. As a matter of fact, the best friend, BFF of the markets, no question about that. And the reason for that is that they are trying to make sure that, well, the economy does heal, of course, and of course the dual mandate of getting the employment to their maximum sustainable employment levels, whatever that exactly means. But they are trying a grand experiment here. They're seeing if they can actually finally get inflation to move. And boy, did they ever. It wasn't just what they did. Really what it was all about, it was a combination of the low interest rates, the fact that we saw fiscal stimulus combining with that, and that was really the spark and the fuel that made the inflation rate, which we saw at a 9.8% year over year yesterday on the Producer Price Index. Wow. It's here. It's not just an overshoot, it's a significant amount of increase over the top. Federal Reserve continuing on their accommodative policy, that was a major theme. But again, we had this whole thing about inflation and the question about it being transitory and luring us into this idea that, yeah, inflation is just going to stick around for a while. Hey, I have a surprise for everybody. Pay attention to this. Inflation is always transitory. The question is, how long of a time frame are we looking at? In the beginning, the Fed was all about this transitory nature of it being about 3 or 4 months, maybe that's about it, and it's going to kick back where it was. And we had supply chain issues and some concern about, the ability for price to stay level for some time. And then they finally gave up on it, and they said, you know what, the hell with this. We're really thinking that's a much more persistent situation here. And the Fed is starting to really think about what's going on with that. But there's still allowing for a significant amount of liquidity, and maybe too much right now. All right, let's take a quick note and let's look at our poll here. We're going to end the poll. Our results. The number one concern overall, let me just look down this list. Inflation, 54% of the people responded that was a biggest issue. Then we have the political environment and social issues, 51% of the people. Then we go down to kind of a couple of ties in this area. Too much investment or crash, Fed mistake, cybersecurity is kind of low on the list. China and Russia, which we'll talk about in a second, 23% of the people. Climate change, only 6%. That tells a lot right there. Not enough invested rally, not enough. Nobody's really concerned with that. And you know what? Interestingly enough, not a lot of people are concerned about the pandemic. So that is kind of interesting also. I think that really shows us where we are, and I think that really puts a fine point on the fact that there's not a lot of concern about the pandemic. We are concerned about inflation. We are concerned about the political environment and social issues that are going on. And that leads us right into where we are here, right? That leads us into the issue of the idea of, well, where are we in terms of this geopolitical situation? We have rising concerns with regard to China. Clearly, that's been an issue for years now. Not only are we putting tariffs on them, but there's a lot of things that are happening, like they're pulling and forcibly being forced to pull their companies off of our stock exchanges. We're starting to say, hey, you know what? We're not sending people over there to Olympics. Russia, with some of the invasions that are happening, possibly the political instability and the issues revolving around some of the oil, and there's a concern there, some natural resources as well. The other thing that's really a big issue back in 2021, I think really one of the more important related to inflation and prices is supply chain constraints. Back in the day, Michael Dell really revolutionized the idea of just-in-time supply chains, whereas we would have different suppliers and logistical situations coming together and providing for a seamless, we'll call it end product delivery process of a purchased good to people, to businesses. And the problem with that is that that's all fine and good when there is a smooth supply chain and demand curve. When we stop and start the economy, something that nobody planned for, nobody ever planned for something like that, that's where the problems came in. That is a big part of the inflationary numbers. In fact, one of the things I saw today was some wholesale inventories were growing, and some people are very concerned about that, wow, wait a minute, maybe sales are down a little bit. And I'm thinking, well, if wholesale inventories are rising, two things are probably happening. Number one, a lot of places in the wholesale side, the manufacturing component area, is thinking that, maybe we should buy our products now, get ahead of this possible massive inflation that's going on. The second thing is, if there's excess inventory, possibly that will start to cause prices to come down a bit. We are clearly in a situation like we saw with lumber, like we saw with copper, like we saw with coffee and sugar, like we saw with many commodities. In fact, we saw with oil recently at 84 dropping to 69. There is this idea that we're going to have this absolutely forever, but in fact, I do believe we have some kinks in the supply chain, kinks in the demand curve that is causing a lot of this that will slow down and change. Now, am I in the transitory camp? I don't think so. I don't think that there is a significant amount of transitory in this at all. I think it's here permanently and it's going to be here. But one of the problems we have is that it's going to take some time. It's going to take some time to move through the system. So big issue right there. All things digital. Big year for things like cryptocurrencies, NFTs, or non-fungible tokens, which we do not have enough time to get into the discussion with. But the Metaverse, big issue. In fact, for the TDI Managed Growth Strategy, we have a major component, well, at least a component of companies like a Roblox or a Facebook or Meta right now. NVIDIA is a big one right there. There's several companies that we have added to the portfolio for things like payment processing or the superpower behind creation of the metaverse. So that takes me to my next poll here, which is coming on your screen right now. Is the metaverse, single choice on this one, all hype, never going to happen? Interesting. Well, let's see what's going on. Wow, this is amazing. The next digital revolution. Big questions about this because there's a lot of money going in this. Now, when I look at this and I say from a skeptical old guy's kind of point of view, who in the right mind is going to want to hang out in the metaverse and date and go for social? And how does that work? Well, on the other hand, I put my investment hat on and I say, though, whether or not people are going to do this eventually, I know the build out from what I can see is in the multiple billions of dollars. Therefore, there's an opportunity to invest in these companies that are working on this build out. Whether it's looking at the companies like that are running on the NFTs or that are using for payments, whether it's the Sandbox, whether it's Decentraland, whether it's whatever it is, they have currencies and they're all running on Ethereum. The non-fungible tokens, you could buy these sneakers from Nike now, and you could buy various avatars, and you could utilize them. People are buying land, some of the land that's being bought in the metaverse, which is basically on a computer screen. That's all we're talking about. All this is being bought inside the metaverse, and some of it is at higher prices than the real thing. There was a recent buy of a boat, the Mayflower Meta something or other, they called it. Somebody created a boat that kind of was like you could physically move around it. It looked like a Lego boat. Somebody bought it for $650,000. $650,000. Kind of crazy. So what's happening here right now is something that is pretty substantial. And this poll, here we go. A lot of people answering this. Okay. Number one answer, interesting. Let's see. Number two answer, all hype, never going to happen. And a few people, only about 7%, says this is amazing. It's a digital revolution. Oh, is it going to be great? Now let's kind of skip ahead here. The unknowns and the leftovers. The big question is, if it isn't transitory, how long will the inflation persist? Well, here's something that I think we really need to dig into. It's a very, very easy calculation. If inflation was up 9.8% on a year-over-year basis from a wholesale standpoint, that's not CPI, but whatever the number you want to pick. Let's just use just round number for the heck of it for easy calculation. Let's say 10% per year. So if we had something that was $100 last year and it becomes inflated by 10%, then what's worth, now you got to buy it for $110, right? $110. Okay. What's interesting on this is that if inflation goes back to quote unquote normal, right? Normal inflation, 2%, 2.5% next year. That doesn't mean that the price is going to go from 110 back to 100. It means it's going to go to 110 times 2.5% for the end of the year. So it'll be $112 at the end of that year. We didn't actually get a reprieve from the price hike. What's important to understand here is that whether or not inflation persists, what's going to happen is there's going to be a significant amount of price that is going to be higher than it was in the past. The price issue is sticky. What happens is there's going to be maybe a move down in the growth rate of inflation. That's where the Fed was being very tricky. And what's going to happen here is we're going to see prices higher in the future. Big issue that we really need to get used to, I think, in this situation right now. So what else do we have? We unfortunately have the potential for new COVID variants that we're seeing right before our eyes. Doesn't need a lot of discussion. All of us are immersed in this, I'm sure, all the time, trying to figure out what we're going to do, where we're going to go, how we're going to do. Do we mask on, mask off? Do we vaccinate? Do we double vaccinate? Who knows? So the thing is that this is going to be a big issue. Right now, it is spreading dramatically in the UK. Major shutdowns going on over there. Business is a big concern with oil, commodities, that this is going to be another major issue, even though that, is it a mild or is it not a mild? I don't know. These are all the things that, unfortunately, we have to know right now. And the bigger question is, and I want you to really consider this, is this a forever thing? Is this going to be endemic instead of a pandemic? Are we going to be dealing with this forever? And if so, what does that mean? What does that look like? And how are we going to deal with that? Because right now, going on where are we? We're going on 3 years now? 2.5 years or something like that? Where to start? We started a whole year there. 2020, a whole year. 2021, a whole year. So we're into the third full year we're about to begin of this pandemic, which now makes me think it's endemic, and we're going to have to deal with this moving forward. Whether or not you want to go out or not to a restaurant, whether you want to fly or not, up to you, but it does seem there's going to be a major issue there. Equity valuations. Here is something that's a very significant issue. When we look at equity valuations, I think that there is a substantial amount of fluff, and that has been coming out, though. It was a great chart we showed last night on DH Unplugged podcast, and that chart was all about the idea that 39% of the NASDAQ is, 39% of the NASDAQ itself, on average, is 39, the stocks are 39% below their 52-week high. That is pretty substantial, very substantial. So what's happening here is that we had a little bit of a hiccup due to excess exuberance in the markets for a while. Now it's starting to come out a little bit. One of the reasons was because we saw this gamification. The gamification of financial instruments, where it was really easy to get on your phone or anywhere easily margined up and buying up. And if you did right, well, you get some fireworks that displayed, and everybody was excited with their trophy that I did my 10th trade, and I made my 10th positive trade. I get another trophy, and everybody was kind of involved in this whole thing. It was pretty interesting. So what we have is a situation right now where that is also I don't want to call it a bubble, but I'll call it an interest that is waning. The interest is waning. The other point here is that in moving forward, this is a real big question mark. And I really put this out there to make you think about this, because we've been thinking about this a lot as we construct portfolios for you. And if you are clients, or if you're not, when you become clients, when we do construct portfolios, the question is, what does the outlook look like? That's an everyday, all day, all the time question. But what is the outlook in these particular circumstances right now? For example, we have corporate margins that are impacted by rising wages. And the concern that we have inflation that is increasing the price on either raw materials or inputs of whatever you're utilizing to create something, whatever that is, whether it's a ham in a sandwich or whether it's a pipe to make a toilet. I don't care what it is. There is an increase in the overall cost factors of those things. And when we look at that and when we start to spec that out, we wonder how much that can impact. And if, in fact, there's going to be the ability for many companies to pass that along. And if so, well, that's okay. But how much and how long can that last? Big issue. So I think that when we look at this and we talk about this, I think the big issue right now is we have to watch for corporate margins. Right now, they've been continuing to expand, while we have in the TDI Managed Growth Strategy one of the largest components of equity allocations, because one of the things that we watch very carefully is stocks having the ability to expand or at least maintain margins. And if you don't, you're booted from the portfolio. So I can tell you that that's a big issue right now, that corporate margins have been really strong, and we've been seeing a lot of expansion of that. And that's a really good thing. Think about it. That's why you get a significant amount of earnings beats, because once you have that ability to expand your margins, your ability to be profitable and a much greater amount of profitability is very significant. And finally, the other thing in this chart, in this list, if you will, is working from home and the Great Resignation. You know, all these people leaving to go to the gig economy and saying, hey, I'm working from home, part-time, full-time, whatever I'm doing. And this idea that, you know what, screw this. I don't need to work anymore. I can just get by doing my thing, going on and being an influencer, or maybe buying and selling these NFTs, or, you know, driving an Uber, whatever it is. So here we are, kind of with a very strange environment that we wonder, are the numbers we're seeing in the area of economic activity actually accurate? Right? Question. Big question. All right, we got another poll we're going to launch here. Let's keep it fun and keep everybody awake. This is about inflation. Inflation prospects for 2022. We're going to have deflation, no change, hyperinflation, stagflation. We'll get to that in a second. Let's see what we got next. All right. So what to expect in 2022? I'm going to kind of bang through as we talked about some of this, but we're going to talk about this a little bit more. Inflation is no longer transitory. Well, hello, we know that. We saw talking about that on the Disciplined Investor podcast. If I said that one time, I said it 1,000 times over the last 6 months. Inflation is not and never was transitory. Yes, hyperinflation like we're seeing right now, yeah, that's transitory. I'll give you that. It's only going to be around for a little while. But you know what? When you move past that, I think there's a significant amount of reality check that needs to be done here, and that some inflation is actually kind of good because it helps with the velocity of money. It actually helps the economy. It actually helps for jobs and wage growth, etc. Big issue, though, is wage growth keeping up with inflation. So the Federal Reserve came out today. They said they're going to adjust the taper, moving to $30 billion of reduction, $30 billion per month, looking like they'll finish up probably in February, March of next year. They said everything they needed to say today. They're shifting to a bit more, I wouldn't say away from accommodative, but just accommodative. You know, they're not fully accommodative right now. They realize that there's going to be, that there is a significant amount of potential for a disaster from a policy mistake if they really start clamping down too fast, a la Paul Volcker back in the 80s. We're not at that level at that point yet, but they are kind of shifting a little bit. It's kind of the end of the free money, and that's a big issue right now. The idea that we're seeing that the free money, easy money, high liquidity is pretty much fueling everything out there is very significant. And I think what's exciting is right now that if we could get back to a more normalized, eventually, a more normalized interest rate environment where, in fact, we're not forced to look for alternatives, where we could find places to invest that are free from excess speculation, and more so where we have price discovery. Right now, there's no price discovery because we have a 10 billion pound gorilla buying bonds at any price with no price sensitivity at all. They don't care what they're paying. They just are buying $100 billion a month. When we get out of the market, we'll see really what kind of plays out. That's something that we have to really pay attention to. All right, let's take a look at the poll. Inflation prospects for 2022. Biggest and most chosen answer was no change, stays the same level, 38%, followed by hyperinflation of 22%. Nope, excuse me. I take it back. Stagflation of 33%, which I don't think we're going to get. Hyperinflation of 22% and deflation of about 8%. Kind of interesting. The other thing that we got to talk about, and I think we really need to put a significant amount of thought into this, and that is the metaverse, the build out of the metaverse. Whether or not we believe and you believe you're going to be talking with a bot or an avatar or involved in it with an Oculus unit, and if you don't know what that is, then probably you're not going to be. And buying things with NFTs and getting yourself some skins and utilizing crypto to, and if again, all this doesn't make any sense to you, you're probably not going to get involved. But if it does, this metaverse is really interesting. You know, the Web 3.0, the ability to use frictionless, decentralized, all the buzzwords that we look for with payment processes, etc., and the ability for us to meet, greet, play, and stay inside this metaverse, which again is pretty much a virtual reality world inside a computer simulation, essentially. Kind of an interesting play. But again, this build out, this is what I'm interested in. I'm interested in figuring out where we can make the money on this build out. And there's plenty of opportunities that we're finding. And we do that within the TDI managed growth strategy, particularly. Now, we also have the big issue with EVs, electric vehicles, becoming maybe a 30% overall market share of all the cars in the next 5 to 10 years, probably in the next 8 years, I would say, if we're going to go out there. Space exploration. We're seeing like Blue Origin and SpaceX, and we're seeing many companies try to get low orbit satellites up there for internet coverage, and we're seeing that there's a significant amount of long range being done as well as joyrides as well. All foods, I don't know, question whether we're going to be eating mung beans or pea proteins or what's going on there. Something that we're looking at, we're continuing to pretty much hate, but it's something. It's not, it doesn't seem like it's a profitable enterprise at this point. So we're staying away from that, but it's something that we have to kind of keep on, looking at that. Cryptocurrencies, the coins, the alts, the core, whether you like the Shiba Inu or the Dogecoin, whether you think that, hey, all this is crap, maybe Ethereum is good because they could run some of this. The NFTs, very strange environment. Where we see people putting JPEGs, images, pictures of what they draw on for sale and other people buying them for some ridiculous amount of money. It's kind of a crazy world out there right now. There's just too much money floating around and too much hope for, I guess, in a weird way of changing everything and disappearing into a world of make-believe. That's the thing that concerns me about all this metaverse and NFTs. It's a very strange situation. One thing also that we have to really pay attention to, I think, right now is this area of volatility because of a liquidity reversal. If, in fact, we do see that there is a significant amount of money that moves outside of or moves out of the out of the bond purchases and possibly due to an increase in interest rates, we're going to see a liquidity reversal if all the margin that's out there and all that. Now, today we saw the reaction of the markets, which originally started out pretty ugly at 2 o'clock on the nose when Powell put out his press release that they're going to change up a few things, and it was a little bit more hawkish. Then everything reversed around from about down a negative 160 on the NASDAQ to up 350 by the end of the day, a 500-point round trip on both the NASDAQ and the Dow, which is a very substantial move. It was prime for that. If you follow me on Twitter, I talked about that 2 hours before, that this looks like what the play is going to be. Way too much setup on the short side, way too much over the last few weeks, hitting on the technology shares. Look for a major rip-your-face-off reversal if, in fact, Powell is as hawkish as we expect him to be, but no more. It was set to blow very easily. So, there was some really interesting things that happened overall in terms of the environment that we are in right now. The fact that even if we get 3 interest rate hikes in the next year, we're still only going to be at 1%. And if we have an inflation that's at 4%, we're still at a negative 3% net real yield. We're still at negative real yields. That is very favorable to markets. Now, it's not all peaches and cream. It's not. But the fact of the matter is we should start to see a change in the investment themes that are coming. One of the big issues that I'm looking at is, once again, played out very nicely at the beginning of last year and the end of this year, value over growth, looking at the banks, pushing all of our portfolios, the disciplined investor managed growth, adding some of that, but that's more of a growth orientation, but looking for high quality growth. Investology, as well as our global allocations, are slanted and slightly have a greater diversity towards value banks and utilities and staples over growth and over things like healthcare. So what's interesting is certain healthcare. But point here is we're looking for quality growth and value. If we do see the yield curve start to unflatten and start to expand, we start to see it normalize. We see that the rates start coming up a little bit, and we get that real benefit and bang to the banks and the financials. And we see that there is a move towards cyclicals once again if we get the, dare I say, the Build Back Better plan, which, okay, whole different discussion. Fact is that there is a lot more value embedded in the overall opportunity inside of the value component side right now over the go-go growth. It just is. There's also more value in the international versus domestic area. Clearly, emerging markets are getting hurt as the dollar moves higher. That is giving us some really good opportunity, in my opinion, with this. I think there is a significant opportunity to look at where we are in terms of the valuation proposition from a domestic versus international, from a large to a small, from emerging to a developed. And I think when really you have to consider the fact that over the years, we do see usually a lot of movement from one side to the other in a trend. And we're going to look at that in a second and show you that. But what's going on right now is there has been a very big slant towards the domestic U.S. over international. ESG, environmental, social, and governance. I'm going to bring on the old Scrooge here, bah humbug. Now, while there's a lot of investment advisors and money managers that pay a lot of attention to this, this is, I think that there is a significant amount of overuse of this ESG. And this whole idea of where we are with regard to buying because these companies say they are green and because they say they're environmentally conscious and socially conscious and they have the governance, and where we have this greenwashing that's going on that's very clear and distinct with a lot of companies just buying carbon credits and doing things that are outside the box to try to get themselves into this ESG universe is just stupid. And the fact is that's going to be uncovered, and we're starting to see just the green shoots of this kind of undercover work and getting the flushing out of the BS, frankly, of all this is starting to happen. The other thing is that we need to look at, of course, is the U.S. dollar and Treasury yields. And the fact is that, when we look at the U.S. dollar and the move that it's made, we have to check back and think about how much is this going to move with respect to the movement of the Fed and the benefit of the U.S. being a lot further ahead than other countries, or is this going to start to dissipate from what we saw the last few months? Treasury yields probably moving to the upside. Eventually, they have to. They're going to be forced to move to the upside. That's the bottom line on that. So what I want to show you here now is the sector rotation. This is really interesting because here we are, year to date. Who would have thought, right? Who would have thought that year to date, this year, the U.S. Real Estate Investment Trust would be the top performer for the year so far year to date as of yesterday. Commodities up 24%. Now, when you look at this, we color code this because I like to look at this on a regular basis and see the rotation of how things move from one place to the other. REITs have been in the top 5 since 2015 a few different times. You look at the bottom of this year right now, and when we look at this right now, you can say, well, I guess that what we're seeing right now is a significant amount of kind of lackluster performance in the bonds and the emerging markets and foreign REITs. Now, again, you have to look at that. A lot of times what happens is you see that kind of a situation happen, and then it rotates. It goes from top to bottom, or it goes from bottom to top. And you see this on a regular basis. So what I'm looking at here, and when I think about this, is, you have to take this all with a grain of salt that the top and the trend stay solid for a while. U.S. large cap, 2019, 2020, top here, top 5 here, top 5 here, top 5 here. 1, 2, 3, 4, 5, 6. Every year, U.S. large caps have been one of the best. When we look at U.S. REITs, you look at the composite of real estate investment trusts, which covers all the REITs, and you see a 32.5% move. We know that has to do with the low interest rates. There's nothing to explain here, right? We have unbelievably low interest rates. It is pushing housing price. Have you seen your housing price on Zillow recently, right? So what I want you to consider, I want you to look at is this idea that, hey, we do see these rotations and we're trying to take advantage of that. And we utilize most of these, if not all of these, inside of our portfolios, primarily for Investology and for global allocations. We look at this, not only this, but we try to speculate, okay, what are we seeing that has value, that also has a trending factor that's positive? That's going to take us to our next poll. What do we think is going to be the best sectors next year, generally speaking? Now, I split these up a little bit differently than we have here, but we can look at this and try to take a look at which we think is going to be in the top moving next year. Because, you know, when we look at this and we think about and we do the research into where things are, considering all the things that are there to play, right? The impact of COVID on these other countries, the vaccines that are uptake in those countries. You know, what is the state of affair in terms of travel, business, and the environment? How are we going to look at the tariffs and the cost factors? Who is reliant on oil in other countries for many of their goods that could see the biggest problem from input costs versus getting them locally, etc.? All this is a big issue. Where do people have to ship in from with all the shipping costs that have gone down? All this is a big concern that we look at on a regular basis all the time. And what we do is we try to figure out, okay, where do we want to be? Right now, again, we're going to be slanted towards the large caps, which we are. This is going to be on the value side. We split that in half, and you get the value side of the large caps. We have a piece of mid caps, a little bit larger, and small caps right now. We have all this also. We've been adding mostly right here, and we've been rebalancing into emerging and into foreign, because we do think that we're going to see a resurgence of that, especially if we see that there is an opportunity that's created by the dollar that is going to could benefit that. All right, let's move on to this one. In a minute, we'll stop that poll. This is a domestic style rotation. You see something kind of constant here? This can go back a little bit further and wouldn't look that much different. But we got U.S. large growth, U.S. large growth, U.S. large growth, U.S. large growth. Amazing look at what's going on right here, right? We have, when we look at this, 1, 2, look at this, right? Every year, U.S. large growth. What's interesting is actually up until last week, this was the number one this year. And it moved down, moved right down, right down, right down. So what's interesting here is right now what we have is a situation where are we going to be? Well, I am favoring right now the U.S. large cap value. That's right here. This is what I'm favoring right now, because I do think that we're going to start to see this play down. Why? Because valuations really are enormous when it comes to the comparison of where we are with interest rates. U.S. large cap growth gets a big check mark when it comes to what does well in a low interest rate environment. Okay, that's great. Okay. All right. Well, what does we do well as interest rates are coming up? Well, this is all about banks and energy right here. U.S. small cap value really charged ahead dramatically this year because energy came up from the bowels of hell, right? Negative $40 on a barrel of oil, and it moved right up. Small value really did well right there. U.S. large value, again, doing really well, had a better part of the year, the beginning of the year, and then all of a sudden, U.S. large growth took over. When we look at domestic style rotation, what I want to look at right now is the idea that I'd much rather be in better value, slanted, tilted ever so slightly. And that's going to be our U.S. large value and our U.S. small growth. Just to let you know, that's where that goes. All right, let's end our poll. Best sectors for 2022. Well, no surprise. 34% said technology, 25% said healthcare. 14% said industrials, 10% in utilities, and 10% in consumer related. All right, moving along. I want to make sure we have a couple of minutes for questions. Here's the Federal Reserve shifting. A couple of charts just to go through with you here that I think is interesting. We saw the move, the assets in trillions, right? We went from 4 trillion up to about 10 trillion. Here's your little chart right there that moves it right up. Here's the effective Fed funds rate, obviously starting in 2019, and then obviously in 2020 dropped right down to zero. That's right here, zero. So clearly we are going to see that change. Now, whether or not we start to see this roll over or not, I don't think that's going to be the case. I think what we're going to see is the fact that we are going to have a significant amount of just steady eddy. It's going to kind of be like this for a while. This is going to start to come up, though, a little bit, right? You know, the idea is we're going to see this line right about here, about 1% at the end of next year. Probability of rate hikes. All right, what do we got here? Well, the probability of a rate hike right now, it looks like that we're going to have, what this is saying is nothing's changing pretty much in the beginning of next year. When we look at the May through June, somewhere about a 45% chance of a one rate hike going from 0 up to the 0.25. And then it looks like the reality of another rate hike somewhere around September and then somewhere around December. That's what it looks like right now. That we're looking at 2 to 3, right? So somewhere in here, there's going to be a hike. And when you look at that and you start to think about where we're going to be, that's how we get to this 0.9 number. We get 1, 2, 3 hikes, 25 basis points each within a range. So important. I got one more poll here, I think. Here we go. I'll launch this one because we talked about domestic versus international. I'll let you throw that up there. Domestic or international going to be the play for next year. So right now, I don't think the Fed's going to be reducing anytime soon. Again, buyer with no price sensitivity. They'll be stopping the quantitative easing, rolling things off, but probably reinvesting. They really didn't talk about that. Not a lot of people talked about that today, but looking to reinvest the proceeds back into the markets. Here's what I talked about valuation. You probably have heard me talking about this before. We peaked out back in 1999, right? Right about here, right about this level here. We saw that there was a significant amount of price to earnings ratio increase on the CAPE, the cyclically adjusted price average. And that takes a 10-year basis. That's what we're looking at, the 10-year average of this right here. Well above. Very rarely do we get so far above like we got here. I mean, we saw it here. There's no question. And now we're seeing it right here. And we're at the 35-40 range. 37 change, I think, is the actual number. And when we look at that right now, we really have to be concerned that we're so far above this line right here. Look at this. Just so far above. And that's a big concern of mine. Big concern of mine. But at the same time, I have to recognize that a lot of this is due to the fact that we have some ongoing technology, margin expansion, lower corporate taxes, and a very, I would say, easy Fed. So that's obviously the point there. One more minute on that poll, and then we only have a couple more things to go through here. Let's see. Okay, here's some inflation trends. I mean, just to really put a fine point on this situation, when it comes to inflation right now, I mean, here's the PPI, this overall green line that we see right here. We saw the major uptake and move of the PPI up to the 9.8% this week, and we'll see some further CPI this week as well. So there's no question that there's inflation going on here, right? There's nothing there that could say otherwise, and we're seeing it around the world as well. I mean, yeah, China and Japan are kind of in the low zone right now, but you look at everything else. You look at Canada, you look at the Eurozone, everything is picking up dramatically, and it's all the same. It's just a global glut of money and liquidity that's being put on by fiscal stimulus and government largesse, if you will, of making sure everybody's happy. And then, hey, if we shut down, nobody cares because we'll just pay them. And then on top of that, low interest rates, that combination is very, very significant. Last point here, last chart that I really want to look at here is, the whole idea of where we are in terms of job openings and the full employment. The Fed, Powell talked today about this idea that we need to get to full employment. Never really answered the question, has not answered the question of what that even means. I mean, is 4.2% not full employment? 3.9? 3.8? What is it? Is it a moving target? Which it is. They can just keep that going forever. And will we ever get back to 2019 levels if with the gig economy, this great resignation, people saying, the hell with it, I'll just, work here and there. A lot of new businesses birthing. We have incredible amount of companies that are being formed by individuals and maybe not being counted as employees. A lot of people decide, the hell with this. I'm going to work for myself. I'm going to be the master of my future. I'm going to go out and make it happen, and therefore they're not counted. So I really don't know. We see a labor participation rate. That's a big issue right there. The labor participation rate dropped off a cliff, obviously, into the pandemic, only recovered about halfway. That's a big reason why the unemployment rate is kind of where it is right now. It's probably a lot different than that number. That is what the Fed is saying, that there's a lot more work has to be done. But look at this. This is unbelievable. The job openings, over 10 million job openings right now. Very significant situation that's going on with regard to, the overall, situation with jobs and this weird environment that, wait a minute, people don't want to work, but we have all these job openings, but they can't be getting people to work. When they do work, they don't stay, they don't care, they don't, you have to treat them with kid gloves. And I mean, it's a very strange and very odd circumstance that's really happening right now when it comes to employment and the raises that are going on, which needs to happen, of course. But right now, we just got to wonder if we're ever going to get back there. All right, let's take a look at that final poll. 68% domestic and, of course, 32% international, which is right what I would have expected, actually. All right, a couple of things. I want to mention that, of course, all the things that we talk about, you can find more information on the podcast, Disciplined Investor Podcast, each and every week. Last week, we had a great guest. This week, Danielle DiMartino Booth, the Fed Whisperer, who has been in the Fed, worked with the Fed. She's going to be on to decipher what the Fed talked about today. Coming up this week, last week we talked about NFTs, cryptos. We talked about the Metaverse. We talked about weed with Ross Gerber. That was a great conversation. And of course, DH Unplugged every Tuesday night, myself and John C. Dvorak get together and we talk about, well, all sorts of stuff. We kind of have a lot of fun talking about things. All those available on any podcast app that you have. Make sure to listen to those and participate. More importantly, if you go over to the disciplinedinvestor.com where this replay will be posted, that has all the information on how you can get involved in either the global allocations or Investology. Explains a lot about what the minimums are. $500,000 is our basic minimum for global allocations, where we utilize a sector rotation process, rebalancing, oftentimes dollar cost averaging to get you 1 foot in, 1 foot out, which you've heard me talk about. The flower garden, once you get that diversification, where hopefully something is blooming at any given time of the year. Investology, kind of the mini baby of the global allocations, $10,000 minimum. It's our answer to robo-advisory. It's technology enhanced and advisor driven, if you will, overall program. And then TDI Managed Growth Strategy, which is an aggressive trading strategy. Long, short, can go both ways. Right now, I have a small short on, some cash buffer, some of the Metaverse stocks, and then a good smattering of high quality growth. And if you want to talk about some of the numbers of our core equities, we just ran some numbers on that I can share with you that are pretty impressive. Okay, all that's over on thedisciplinedinvestor.com, or write us at info@horowitzco.com. Let's get some of these questions. We have a bunch that are stacked. And let me take a little swig of this here. Okay. Answer the questions. If you have any questions, put them in the Q&A. Aaron says, welcome to Canada, Andrew. Thanks. Thank you so much. That's nice. Somebody asked the question, thoughts on the FOMC meeting today? Thoughts on the FOMC meeting today? I think there was a big, I think there's going to be a hangover. Let's say that, first of all. I think that we went a little bit crazy. There was more of a short squeeze than anything else. There was a bit of a sigh of relief when the information came out and he wasn't as hawkish, which I can't imagine anybody really thinking that Jay Powell was going to be hawkish, especially after he was reappointed and renominated. But the bottom line is, I think we're going right along the course that they're setting out. I'm not a really big fan of the Fed, but you know what? At the same time, I know we can't fight them. But the fact is they're setting on a course that they're going to slowly but surely try to raise interest rates back up to levels of non-emergency normality, if you will. And that's going to be a big issue. I don't think there was anything really incrementally different at all. Somebody asked me about Treasury I-bonds advice. I mean, we hold inflation-protected TIPS, or TIPS, Treasury Inflation-Protected Securities, inside our portfolios, both on Investology as well as inside of our global allocations. for our clients. You could buy these as a limitation. You can go to just look it up, Treasury I bonds. There's a certain holding period requirements to get the interest, currently yielding about, I think 7.2%, I believe is the number. Interesting, as long as you understand the parameters, it's not much you could buy of these things. I think it's a limitation of like $10,000 or so. But I think if you can buy them and you want to do that and you understand all the parameters of it, safe, good investment, no problem. Next question is, I'm very interested in investing in NFTs, but don't trust myself. And I'm not interested in selecting the particular ones. Are there any funds managers that you're aware of who might select a basket of NFTs to invest in on behalf of individual investors? No, I don't. That would be interesting to do. I know people that are doing a lot of buying and selling and trading of NFTs. Not something that I would do. I don't know. I can't give advice on this per se. I mean, it's pure, unadulterated speculation. Next question. Opinions on biotech at this point, are they way off their highs and seem to be looking at like a better opportunity in the mid to long term, or is there still a lot more pain to do to interest rates? I think there's a different situation that's going on with biotechs. I think there's a lot of people aren't getting sick, first of all, the usual way, because everybody only has COVID, it seems. And a lot of people also stayed away from doctors for a very long period of time. Therefore, some things went undetected and some people weren't getting the medications. And there wasn't a lot of diagnosis out there. But I think also there is a kind of a shying away of them. There is something to do with interest rates. I agree with you there on that. And I think that there are some great opportunities. I mean, listen, if you really think about the functionality of the mRNA through Moderna, Pfizer, Biotech, et cetera, these companies that have been doing a great job at really the next stage of evolution. And look what's going on with CRISPR, whether it's CRISPR technologies or edit. These have been just shot to off the cliff. These stocks are down 50, 60, 70%. And there's some unbelievable technology behind them. Now, you could also go right to the very basic pharmaceuticals that are just kind of dishing out, creating, white labeling, manufacturing, distributing. Interesting. You know, everybody's going to have diabetes, probably no cure in the short term. The same thing we could say for many other ailments. So I think it's a part of the portfolio, and I do think there's some opportunities there. Yes, I do. Yes. Next question comes in. What stock sectors do you like in 2022? I think I talked about them earlier, about the general sectors. You know, you have to slant towards high quality growth, high quality technology, I think will be good. Again, the metaverse / next generation of web applications are going to be important, I think, as well. Still a big fan of the major players out there. In addition to that, I think there is significant opportunities in the banks, as boring as that is, and very rarely do you hear me say that. But I think there's opportunity there. And I also think internationally, as we talked about, is pretty significant. Okay. Next question. I've heard you say on the podcast that you would not recommend buying stable coins like USD at exchanges like Voyager that pays a high interest rate like 8 or 9%. Why is that? No. I really never even said that. First of all, I think there's going to be a lot of, I said that I'd be careful because I really don't understand them, frankly. I don't understand how they're paying 8 or 9%. I think we all are in the same boat there, right? I mean, how are we getting 8 or 9% of something that's supposed to be a stable coin that has no risk, right? I mean, there's no risk, 8 or 9%, no risk, 8 or 9%. How does that work? Well, we know there's a lot of lending and a lot of leverage and a lot of multiple leverage that goes on. Okay, put that aside for a second. The biggest issue I have with stablecoins right now is I think the regulators are very concerned about these. They've talked about it. Gary Gensler at the SEC has talked about this. He's brought this up. I think they're going to attack this. I think there's a concern. And if you don't get the right one, those interest rates are going to be nothing compared to the losses that you'll take on that. So I think you just need to be very careful, do your homework, understand there is, in fact, regulatory risk overhanging it. But then again, there's some opportunity. Next question. What are your thoughts on the impact of disappointing Q4 because of inventory backup leading to a lower growth revenue? For example, it seems like there's a good chance for the purchase to be pulled forward, hurting. Well, yeah, that's exactly what's going on. A lot of pull forward going on. The question is, how much is that going to hurt? You know, if you have the opportunity to have a pull forward, but the price were higher, and that was enhance your margins, and you know what? You still made your nut because you got the same amount of sales in November instead of December necessarily, depending on where your quarter lies. and you were able to have a higher price factor on it with lower overall expenses, which has been the case right now, still a good opportunity. Again, you have to be picky. You have to figure out those sectors, companies that have the opportunity to actually push margins, that have the ability. Like, for example, this is the best one to always use. It's so easy. On Netflix. Netflix can up the price of their service by 25 cents, $1. Nobody's going to flinch. Now, right now, they're a little bit of a pricing war with Disney. I think it's Argentina, if I'm not mistaken. That's going to be a problem. But follow me here for a second. You got X million number of subscribers. You can increase your price by $1. Hey, that's great. You have the ability to easily increase. Chipotle does that with their menu items. So I think that's something right there. There's a significant opportunity to utilize. Somebody mentioned India, that they're doing this. There's a price drop going on. Maybe that's what I was thinking. So I think that if you have the opportunity to, in fact, have margin expansion capabilities, it's a good thing. I got to move quickly because we're on a time limit here. What is the impact of child tax credit? Seems like a lot was pulled forward. Honestly, Ben, I don't have thoughts on that one. Matt says, I participate in the backdoor and mega backdoor Roth IRA. Do you think the BBB is going to happen for 2022 year? I need to put a stop to my Roth contribution. If it does, yes. Right now, as of this moment, included in the Build Back Better program is a discontinuation of the backdoor Roth conversion. So if you're thinking about doing it, get it going, because it looks like anything can happen. I would think they're probably not going to follow through with that, if you want my opinion, that you'll still be allowed to do it. It's a good planning tool. Next question. What do you think about investing into companies that will provide things, consumer products, in the way of Metaverse? Like Nike, but a virtual shoe store. I think there's some great opportunity, but don't get sucked into the crap. I say that seriously. If you want to invest in it, you got to look at Microsoft, you got to look at Facebook, you got to look at Nvidia, you got to look at Matterport, you got to look at Roblox, you got to look at a variety of the payment processing companies as well. There's a lot of opportunities here, and it's going to be great, but some of it is going to come by the wayside and go. Next question. How serious are you taking NFTs in the meta? I have some crypto, but other stuff has gone beyond me. I mean, personally, the NFT thing, it's beanie babies to me, more so than ever than was the currencies. I mean, I like some of the currencies, Bitcoin, Ethereum. I have some, I own some. We have a flavoring of some of those in some of the portfolios that we manage. We just picked up one of the banks that specialize in Bitcoin lending and lending in the area of the stable coins, et cetera. So I think there is an opportunity there. Next question. Did they choose the right man of the year? I don't know. Elon Musk. He's a hoot. Why not? Next question. What kind of impact do you see vaccine passports having on consumer spending? Whether it's vaccine passports or not, I mean, if in fact, forget about, just for a moment, everybody just hold on with what I'm going to say here. Whether or not you like the vaccine passport, whether it's invasive and all that, forget about all that for a second. This question is coming about finance and business. I assume that if there is no vaccine passport, and if in fact many countries and places do not allow people in, or businesses have a problem with it somehow, somewhere, and we continue on with this whole entire problem with who can go where and what can they do, that's an issue. On the other hand, if we do have this vaccine passport issue, possibly, I don't know, maybe there'll be more ability to go places. I don't know, but that also means that you have to have the vaccine, and some people don't want the vaccine. It's a can of worms that I really don't want to get into because it's impossible. There's no right answer here. I think everybody knows that, unfortunately. Jeff asks, will real estate drop back down, or are these prices here to stay? I think real estate always cycles. Real estate always cycles. Repeat after me. Real estate always cycles. Now, whether or not real estate goes back down to the 2017 prices, or whether they go down to the 2019 prices, or whether you go down to 2007 prices, a lot of different ways to look at it. I will share with you that a lot of the real estate that is being pumped right now, you got Airbnb and people leveraging and buying. You got people just in a frenzy to buy in certain areas around the country, get the hell out of other areas that were locked down and cold. They have an opportunity, once in a lifetime opportunity to work remotely, and why not live somewhere that's sunny and fun? You know, you look at Florida and the waterside houses. Oh my gosh, waterfront, it's ridiculous. Do I think it is going to cycle? It's going to come down? Yeah, I don't think it's going to. Then the other part of the question, my friend, is it going to go up higher then come down? I mean, the idea right now is that we are in a situation that there is a significant amount of fluff inside of housing price. I think we all know that. You know, we see houses selling for $500 a square foot that are just knockdowns. Well, that's kind of weird. So when you look at the situation right now, it looks like that we are going to probably have a continuation until interest rates really start cropping and creeping up, and then things are going to start getting a little interesting. Is there a minimum investment amount? Oh, yeah. So question, is there a minimum investment amount to invest with H&C, Horowitz Company? Yes. $10,000 is the minimum for our Investology. And it's really a cool program that you go and you set up your portfolio by answering a variety of questions. We program through an algorithm to come up with a solution for you. And then we get that and then invest in the back end. We work on it in the back end. $50,000 for the TDI Managed Growth Strategy and $500,000 for our global allocations. Next question. Do you believe in any of the indication of Chinese, Russian, communist conspiracy being deployed on the U.S. society? I don't know. You know, when it comes to all this, you know what I'm here for? I'm here to help make money, make everybody's life good, make sure you don't lose too much money. All this other stuff ends up being just kind of like head filler, right? Whether or not there's a conspiracy to do this or that, at the end of the day, it's all, everybody wants to make money. It's China, United States, the government, the politicians, the people. Everybody wants to do better in life, so we got to take all that. For example, we saw that Japan last night recognized and told us that they have been BSing about some of their economic numbers and fluffing them for years. Nobody cares. Nobody cares. Look at the numbers. And as crazy as it sounds, we do the research to figure out if there's anything that's going to be really awry in all this. But aside from that, you have to trust what the information is out there. The conspiracy side never makes any money. Never makes any money. When I say international, question is, do you talk about any particular regions? Emerging markets. I think that China's going to come back. I think that we have the whole Asian region. That's a very important area. Some have developed. Europe is interesting. Latin America, not as much, not so much, not in love with that as much. But I do think the continuation of the opportunities in Vietnam, Malaysia, in Turkey possibly, if they get the lira straightened out, which hit an all-time low yesterday, is areas that I do like. Is there a general sense, next question, does it matter what the cause of inflation is, supply constraints, or fiscal versus monetary? No, not at all. Here's the point, right? If the prices are going up, the prices are going up. I really don't care what it is. Question is, though, what's going to stop them from going up? And I need to know what's going on to figure out when that's going to happen. If it's a fiscal situation with the fiscal policy, well, I know how much more stimulus is coming into the markets. Where is that going? What's my time frame? If it's monetary, what's going to happen is that, well, as interest rates start pulling up, well, that's that. If it's supply, well, then I got to figure out, like I said earlier, wholesale inventory is starting to move up. That could be something that's important to look at. We have enough time for like 3 more. Thoughts on the U.S. semiconductor, given shortage of China, Taiwan tensions? Are chips the new oil already priced in? So are we talking about peak oil or peak chips? Is that what you're asking me? Like we saw back when? I think that's very much priced in right now. But the point is that the continuation of the advancement of technology is a big problem. It's also going to be a continuation. We're seeing that shutdowns in various areas and regions around Asia that do the manufacturing and production of chips are going on. Lockdowns, lock-ins, constraints are big problems for chips. So that's something that we have to continue looking at. I don't think it's necessarily over yet. Next question or point. It is noteworthy that gold has stayed flat while Bitcoin has continued lower over the last few weeks. Yes and no. I mean, we saw a major reversal today off of the line. That was kind of an interesting move from top to bottom, probably about 10, 12% after the Fed spoke. I do think that, of course, there's an opportunity in both areas if you're investing. We could talk about that differently. You've probably heard my thoughts on Bitcoin, Ethereum as an investment rather than a store of value. Next question. We got 2 more and then we're done. People are eventually going to run out of cash. Ready Cash, can you foresee the slowdown? I don't know who's running out of cash. I don't know why that's happening. Aaron, I don't understand. Next question. I'm from Mexico. Can I invest in the USA? Usually you can. If you can open up an account with Schwab or Interactive Brokers, yes, you can. All right, that's going to end that. I want to thank everybody for joining me today. Each and every week, I want to tell you, listen, I'm hoping for the best, wishing you the best, giving you my best for a happy and a healthy new year. If you have any questions, obviously, you know how to get in touch with us. For current clients, obviously, any questions you have, we're going to be sending out a client profile form next few weeks to fill out. For new clients coming in, if you have any questions, you want to know more about what we do, just ask. We're here. And of course, listen to the podcast each and every week. Thank you so much for joining me today. Thank you so much for being there each and every week on the podcast. My family and my friends, it's our podcast family, right? In the podcast verse. You are great people. Thank you so much. Hope you enjoyed this. We'll have this recording up in a couple of days. We'll send it out to everybody that was registered for this. The best turnout we've ever had on one of these webinars. Huge, pushing the boundaries of actually our subscriptions. So thanks so much for joining me and being there. We're going to end it right now, and I'll see you again soon.